Okay, thank you for joining us this afternoon. Let's go ahead and get started. Okay, my name is Tony Zhang. I am the Chief Strategist here at Options Play, and I'm really excited to sit here and talk to you guys about leveraging technical analysis with options trading today. This is a new topic for us. I hope you guys find this useful. We wanted to introduce this topic because technical analysis is very heavily used in options play. It's heavily used in the daily plays that we select for you guys and the ideas that we put out every day, the trade ideas that's available to you on the platform. So we wanted to spend a little bit of time talking about the different use cases of technical analysis and how you can use it in conjunction with your options trading. You know, my background in technical analysis spans over 10 years, going back in my days of trading Forex and futures is when I started looking at technical analysis, looking at charts, using them to assist me in my analysis and research. So I really wanted to go through the different types of technical analysis that's available to you and make sure that you understand how they differ from each other, because depending on the different types of technical analysis that you're using, there are different option strategies that are useful for the different types of trading. So that's really what I was hoping to take some time and explore this with and show you guys how we trade. And you know what's most interesting is that options trading is very well suited for technical analysis, because it really allows you to take a view on an underlying, regardless of what that underlying is, with limited risk when you're trading with options. It allows you to quickly time your trades as well, because with options you have to pick an expiration date. So technical analysis is interesting because it provides you not only with a potential target price, but also a potential target time, something that you don't get from other forms of analysis like fundamental analysis and things like that. And really, options really help you plan out your trade, because most of the strategies that we trade with, you have a predetermined set reward and predetermined risk, and it's really important that you understand and plan your trades before you trade, regardless of what type of analysis you do, and options kind of forces you to do that. So that's really why I like to combine technical analysis with options trading. So today I hope to show you some of that. Now, this webinar is really for both beginners and experienced traders when it comes to options. We're not going to get too heavy into the options piece today. I'll go over 3 basic strategies that you can use with options in the different forms of technical analysis, but we're going to spend most of our time looking at different charts, looking at different setups. I have quite a few examples to show you guys, and kind of what type of option strategies make sense for each one. So just a quick sound check. If you can hear me, please type yes into the chat window. Okay, great. So before I get started, it sounds like everyone can hear me. Before I get started, I just have a quick poll here to get a feel for the people that are in the room. How many of you guys have used technical analysis in your trading, and how many of you guys are relatively new to charting? Okay, so far, a vast number of you guys have used options trading for, technical analysis for your trading. I would say that that's enough votes here. It looks like about 85% of you have used options trading. Technical analysis for your trading, and only about 14% of you have used other forms of trading, which is great. That means most of you are going to be familiar with most of the things that I'll be talking about here today. And for those of you that are brand new, this webinar is recorded, so feel free to kind of come back to the recording and take a look at that before you start applying this type of analysis to your trading. So let's go ahead and get started here. I'm going to go through kind of what I'll cover here today. I'll spend a little bit more time using the slides today because I want to go through some different examples of technical analysis. But I do have real examples using real stocks to show you guys with the options play platform at the end. So today we'll do a quick intro to technical analysis for those of you that are brand new, just so you understand what is the underlying philosophy behind why you should consider using technical analysis. I'll then talk a little bit about the different option strategies that you can utilize for technical analysis. I'm keeping those strategies to 3 different strategies today, because those three strategies should cover the vast majority of trading that most of you guys do when it comes to options. We'll look at different forms of technical analysis. So we'll start off with looking at chart analysis and chart patterns. Chart analysis is really the very basic of technical analysis, and that's what we spend most of our time looking at. It's just chart analysis. It's really simple, it's straightforward, it's not too complicated, and that's kind of why we prefer it. Patterns are certainly also interesting to look at. They take a little bit more time to get your eye used to spotting these patterns, but once you get into doing a few of these examples, they become a lot easier. Then we'll talk about things like chart overlays. These are indicators that you guys might be familiar with, like moving averages, Bollinger Bands. These indicators that overlay with the historical price chart, how you can utilize those. Then we'll talk about chart indicators. This is probably the one that most people use. So everything like your MACD, your RSI, your stochastic indicators, your commodity channel index, there's tons and tons of those. So we'll cover a few of them because they all generally have very similar outputs. They're just different calculations. So we'll go over those and how you utilize option strategies with those. And lastly, we'll just talk a little bit about the different market analysis you can be doing with technical analysis. And then, like I said, at the end, what I'll do is I'll wrap this up by showing you some real examples of the charts that we're explaining, and then show you how you can leverage those into trading strategies on the individual stocks alone. So let's go ahead and get started. Quick intro. What is technical analysis? It's really simple. It's forecasting the future price of a stock based on the price of the past chart movements. So what we're really looking at is the historical price movements of any underlying stock, ETF, or asset, and we're using that historical price to try to predict the future price. And what this allows us to do is anticipate what is likely to happen. And that's the key word here, what is likely to happen. With any form of analysis, there's no crystal ball. We don't know, there's no guarantees as to where something will go. But looking at price history gives us an idea as far as what is likely going to happen. And that's the key here, why I like to use options with my technical analysis, because since we never know for sure where something is going, options allows me to take a view on an underlying stock or ETF with limited risk. So meaning if it doesn't happen, in the unlikely event that it doesn't happen, I know exactly how much money I'm willing to risk, and I already have planned that when I trade options. So that's really why I like to use the conjunction of options with technical analysis, and I hope to show you guys some of that here today. But most importantly, what's the best part about technical analysis, in my opinion, is that it's applicable to all tradable instruments. So meaning you can use the same type of analysis for stocks, for ETFs, for commodities, for futures, for treasuries, for bonds, for whatever thing that you can chart, you can take technical analysis and apply it to, which cannot be said for fundamental analysis. Because if you learn about the fundamental analysis of banks, it's almost impossible to take that knowledge and apply it to trying to analyze commodities or something else. So you really have to learn each individual sector or individual market that you're analyzing with other forms of analysis. Technical analysis is interchangeable across all markets, and that's personally why I like to take a look at it. It allows me to have a holistic view across the entire market by simply looking at technical analysis. So what does it mean to be a technical analyst? Like why would someone look at historical charts to determine potential, or how do you forecast the future price based on price chart movements? And an important thing to understand with technical analysts is that the what is more important than the why. So a lot of times people will see a news event and the stock will move up or it'll move down, or earnings comes out and you have this huge move in one direction or another. And these are catalysts, and what that tells you is the why. But as technical analysts, we don't really care why something happens. We just want to know what happens based on that. So for example, the news announcement comes out and the stock jumps higher. That's really what we care about, is that jump higher. We want to look at that jump higher in relation to the history of the stock and decide, where do we think the stock's going to go in the future. So we don't really care as to why. And the part of the reason is because we believe that markets are efficient, meaning the price of the stock or ETF or whatever it is that you're analyzing already reflects and discounts all the information that's out there. Meaning it's not like you're going to be able to find the news event and no one else has reacted upon it first. Then you get to react on it first, meaning all news events are almost entirely reflected into the price almost instantly. And because of that, it doesn't matter to us what the news event is or why it happened. We just know that because of that news event, the stock moved higher, and that allows us to make an analysis as to where the stock may go in the future. The second piece of technical analysis is that we believe that markets are not random, meaning markets do have patterns and they repeat those patterns over and over again. They may not look exactly the same, but they certainly rhyme. And that's a very big tenet of technical analysis is believing that markets do rhyme or they follow some kind of pattern, and that pattern does repeat itself throughout history. So that's how we're able to identify these patterns, and then from those patterns predict what is likely going to happen in the future. Now, there are many, many different ways. I would say there are probably infinite number of ways of applying technical analysis to predicting the future or forecasting the future. However, today what we're going to cover is 4 of the major areas of technical analysis and kind of show you guys what people use. So before I get into the actual methods of technical analysis, I want to cover 3 popular trading strategies. And these are ones that we've talked about before on other webinars. If you have not heard of these strategies or not familiar with these strategies, I highly recommend you to go to our YouTube playlist, which I will put a link at the end of this webinar so that you guys can view some of those webinars to learn more about these strategies. But the 3 strategies that I'm going to go over are long calls and puts, credit spreads, and debit spreads. And I'm going to put them in the context of different forms of technical analysis and when it makes sense to use each one of these 3 strategies. So the key underlying theme of all of this is to why you should consider using options with your technical analysis is the fact that all of these strategies allow you to limit your risk using options. Like I said, there's no crystal ball out there, no matter what form of analysis that you do. Technical analysis is one form of that, so it allows you to take a view on an underlying stock, and options allow you to take that view with limited risk. That's really why I like to use this. So what I've broken this down into 2 groups is dependent on the type of technical analysis. And there are certain technical analysis where you have a clear entry price, but you don't really have a clear exit price, meaning it tells you, hey, the stock may be headed higher or the stock may be headed lower, but you may not have a clear target. And for those types of trading, it's best to use these 2 strategies. You either buy a call or a put or trade a credit spread. And those 2 is dependent on whether you expect a quick and fast move or if you expect a neutral or a small directional move. Depending on these 2, how you feel the stock's going to react, you can use these 2 strategies accordingly. And I'll go through these in the examples that I use here today. So when you expect a large quick move, you want to typically buy calls and puts. And if you expect the stock to be relatively neutral or have a small directional move, you're better off trading credit spreads. I'll go through some of the details of that in a second. Now, there are other forms of technical analysis that give you a clear entry price and a clear exit price. So there are forms of technical analysis where you know exactly when to enter and you have a target price. For those types of strategies, you can use debit spreads. This is really for when you expect a modest directional move in one direction or another. So those are the 3 primary strategies that we'll look at for trading. And I will use specific examples in the stocks that we look at using options play. So let's start off with talking about chart analysis. This is my favorite. This is what we use heavily at Options Play. This is what you see on our platform. And when I refer to chart analysis, this is simple stuff like support and resistance levels, trend lines. This is the basic of technical analysis. So you can think of support and resistance lines as really just horizontal trend lines. And then you could also get into, bullish trend lines, bearish trend lines, all types of trend lines of different slopes, but they're all just same variations of the same thing. Okay, and as you can see, on my chart here, I have Halliburton here that's trading somewhere between this 33 support level and this 42 resistance level. As you can see back here in September, Halliburton was trading at 42 on a support level, bounced higher, and eventually broke below that support level, and that became our new resistance level. And it went all the way down to around $33 before it bounced higher back to 42, down to 33, up to 42, down to 33, up to 42. So this is your classic support and resistance line. And trend lines work very similar to this, just that they may be sloping higher or sloping lower. And these types of trades are really geared for, this gives you both a clear entry because it tells you exactly when to enter around this 33 level and what your target is, this 42 level. And because of that, because you have a clear entry and a clear exit, these are typically very good to use with debit spreads because you know exactly where your entry price is and you know roughly where your target price is. You can use those levels to help you select your strikes for your debit spreads. However, you can also use these for credit spreads. So for example, after the stock dropped to 33, went up to 42, dropped to 33, went back up to 42, you may not necessarily know that it's going to go back down to 33, but you can certainly say with fair amount of confidence that this is probably not going to go above 42. And once you get this red candle that shows you that the stock has kind of bounced off that 42 level, you can also sell a credit spread. So you could have done that here too, right? Where it hit that 42 level, sold the credit spread, and even if the stock doesn't really move significantly lower, even if it stays around this 40, 41 level, you're still going to make money on a credit spread. You're just going to not make as much money as you would on a debit spread, and the stock does drop down to 33. So those are two primary strategies that you can trade if you're using support and resistance levels. And this is really where you want to start off if you're brand new to options trading or brand new to technical analysis, is simple support and resistance levels because they're generally easier to spot, and we calculate these support and resistance levels for you on options play, and I'll show you that in 1 second. Next, I want to look at breakouts and breakdowns. This is really where a stock is trading in a range and then all of a sudden either breaks significantly higher or breaks significantly lower. And this is going back to my concept of it doesn't matter why, it really matters what. So it doesn't really matter why the stock drops so much in this short period of time. It's probably likely to do with earnings or news or something like that that caused the stock to really get hit significantly. And same thing here on the breakout. It very well could have been news or earnings to do that. It doesn't matter why. The only thing that matters is what. So here, as the stock kind of dropped below this support level and it started to break down, see these types of strategy, these types of breakdowns and breakouts do have a clear entry because it tells you exactly when the stock starts to break down, but you don't really have a clear exit, meaning you don't really have a clear target price. So if the stock starts to break down, you don't know if it's going to go from 58 down to 48 or 42. You just know that, hey, this stock is breaking down and it might move significantly lower. And because of that, these types of strategies are really good for just buying calls or puts. So if you think the stock's about to break down, buying a put is an interesting strategy or a good strategy to take. And then as the stock starts to break out, buying a call is sometimes a good strategy for that because it allows you to take advantage of a big move in one direction or another, a big quick move. And that's really what breakouts and breakdowns are, a very swift, quick move in one direction or another. And buying calls and puts allows you to profit from that type of trade. I also have here, this is a similar type of breakaway, but this is talking about gaps. So gaps are another form of analysis. I'll try to come up with a few different examples of this, but Tesla was an interesting one lately where it gapped down significantly, came back up, and then started trading lower again. There's lots of different examples of this, but gaps are essentially a very similar breakout. trades. So, a lot of times the stock will gap higher on earnings or news or whatever that is. Once it gaps higher, then you get a significantly move in one direction or another. And usually that move is very quick. As you can see, this stock moved from 32 to 35, about a 10% move within just a few days. And that's really the type of trades that you would want to use calls and puts for, because it allows you to take advantage of a quick, swift move in one direction or another. Next is chart patterns. Okay, this is the second level of technical analysis that I would say once you have some experience looking at some of the chart analysis. Chart patterns take a little bit more training of the eye to spot, but once you kind of look at them for a few times, they become really easy to spot. So these are the types of, I've started with just looking at reversal patterns. So these are kind of like your double tops, double bottoms, head and shoulders, any of these types of strategies you might be familiar with. These type of formations typically tell you when the stock is going to reverse. So a double top tells you that the stock's going to reverse lower. Double bottom tells you that it's going to reverse higher. Head and shoulders does the same thing. Head and shoulders is just a variation of a double top or a double bottom. And what these provide you is a clear entry, but an unclear exit. They don't really have a clear target price. So when the stock hits this double top at $60, as you can see, it hit $60, came back down, hit $60, came back down, hit $60 one last time, and then eventually broke down. And once it broke down below this 53 support level, it really quickly tumbled down lower. And again, because of the fact that these have unclear exits, you can typically use them for calls and puts to take advantage of these large moves down. This is similar to that breakdown example that I gave you. The other type of strategy that you can actually use here is actually credit spreads. And what I mean by that is when the stock hits this resistance level, hits 60, bounces lower, hits 60, bounces lower, hits 60 again and starts to bounce lower, you can sell a credit spread that basically takes advantage as long as the stock doesn't go above $60. So whenever you find a support or resistance level, you can always sell credit spreads at those support and resistance levels. That basically just says, I don't think the stock's going to go above that resistance level, or I don't think the stock's going to go below a support level. You can always sell a credit spread at those times. Next, what I'm going to look at is continuation chart patterns. These are even a little bit more difficult to spot, but again, I have a few examples to show you guys in a few minutes of some continuation patterns. These are essentially patterns where a stock moves significantly higher in one direction, and then it consolidates for a while before it continues going higher. This is very common that we see in the markets because stocks don't ever just go straight up or straight down. They typically will trend for a while and then consolidate. Basically you have a bunch of buyers that came in, then they're probably taking some profits and consolidating, and buyers and sellers are at equilibrium until it starts to break out and more buyers step in again, right? So this is typically what we see in a lot of charts that are moving higher, is that they don't move higher in a straight line, they move higher in waves. And these types of flags and pendants are really good entry areas a lot of times for these types of continuation patterns. And the great thing about continuation patterns is they give you a clear entry price and a clear target or a clear exit, because the move, so as you can see, this stock moved from about $28 to about $36. You can take that measure and actually project out how far it's going to move from the next move higher. So this gives you a clear potential when to enter the trade. As you can see right here around $36 as it starts to break higher, that's when you enter the trade. And then you can say that the target here is roughly in around this $45 range, depending on how far the stock moved in order to get into this flag or pendant or whatever formation. There's lots of different formations that they can choose, but they're all different variations of the same concept. And for these types of trades, you typically will want to use something like a debit spread. And the reason for this is because these are typically not quick, violent moves. These are typically a little bit more orderly, if you will. They tend to move in a slower trend, and that's why debit spreads usually are a little better for these types of trades when you have a continuation pattern. Next, let's take a look at chart overlays. This is very popular because many of you are familiar with overlays. Like moving averages is probably by far the most popular and the one that most people are familiar with. Other ones like Bollinger Bands, Keltner channels, those types of indicators that are overlaid the price chart. These types of indicators typically have a clear entry, but they don't really have a clear target price or an exit price. So with that, you generally will trade stuff like covered calls or puts. So for example, if you have a breakout, you usually have a quick move in one direction or another. That's when you want to maybe use a call or a put, buying a call or a put. Or, a lot of times the Bollinger Bands, they kind of give you an idea as far as when this price has moved to an extreme and it's likely going to come back or reverse back to the mean. And that's really what the Bollinger Band tells you, right? It tells you what the average, which is what this middle dotted line is, and then the two extremes, which is what the upper band and the lower band is. So when it hits an extreme, it's basically saying that it's likely to revert back to the average. And same thing, whenever it hits the lower band, it hits the lower extreme, it reverts back to the average. And with that, you can always sell credit spreads. So whenever it hits an extreme, you might want to sell a put credit spread. And then when it reaches a top extreme, like right here, it goes above that Bollinger Band, that's when you might want to sell a call credit spread because it's going to revert back to the mean. So it's really is this concept of mean reverting, and that's really the type of trades that you would typically use a credit spread for, because a credit spread is essentially saying the stock has moved too far in one direction or another, and it's likely they're going to go back to the average or go back to the mean. And that's the type of trading that credit spreads usually is very good for. Next, let's take a look at chart indicators. This is very, very popular. For any of you that have taken any courses on technical analysis, you've probably looked at tens, if not hundreds of these indicators, and there are many, many, many of them out there, and I cannot possibly cover all of them by any stretch of the imagination. I don't even think I'm going to cover a small portion of them, but indicators like RSI, MACD, stochastics, Williams percent R, commodity channel index, ADX, all of these are all what we consider oscillator indices. What that means is that these are indicators that give you an idea as far as when the stock or asset that you're looking at is overbought and when the asset is oversold. So they basically oscillate between two extremes, and they basically tell you when the stock has kind of hit an upper band and when it's kind of hit a lower band. And that's, again, there are all of these different indicators are trying to tell you roughly the same thing. They just have different ways of calculating it. So let's just take a look at RSI because it's probably one of the most popular ones that many of you are familiar with. Let's just take a look at how you would typically use them. Now, what these typically do is they give you a buy or a sell signal, so they give you a clear entry. However, they don't give you a clear exit. They don't really tell you where the stock's going to go based on these signals. So because of that, they're generally good for credit spreads. So let's take a look at RSI. So as you can see, when it hits this bottom line, that means the stock is likely oversold, meaning it's likely going to move higher. And then conversely, when it hits this upper band, it's overbought and it's likely going to move lower. So as you can see here, I have quite a few overbought signals where the stock doesn't really move much lower. Same thing here. The stock hits this red signal, and it kind of just moves sideways. Same thing here. Hits this red signal, just kind of moves sideways until this last one where it kind of hits the same red signal and then significantly moves lower. So because of this, when you get these sell signals, you don't have a target price of where it's going to go. These are generally good for credit spreads. So when you have this oversold condition, you would sell a put credit spread. That basically says, I don't think the stock's going to go much lower than where it is now. And I think it's either going to move higher or just kind of trade sideways. Same thing here on the overbought indicator. I would typically sell maybe a call credit spread, basically saying, I don't think it's going to go above this $50 level, right? Same thing here. When it hits overbought again, when it's around 52, you might sell another call credit spread that basically says, I don't think the stock's going to go above 52. And then same thing here, as it goes to 54, sell another credit spread at 54, saying I don't think it's going to go above 54. And it will trade, and as long as it trades sideways or lower, you will be profitable. And then same thing here. If you feel that because it's overbought again, you might sell another credit spread at 58, and this stock does move significantly lower. So you're not really going to be able to take advantage of that the same way as someone who bought a debit spread. However, as you can see, if you had bought a debit spread here at 50, you probably would have lost money because the stock just traded sideways. If you bought a debit spread here, it probably would have traded sideways again. You would have lost money. If you traded a debit spread at 54, it traded sideways, you would have lost money again. And only on this trade, as the stock really moves significantly lower, are you making money on that particular trade. So that's why these oscillators, because they don't give you a clear target price, you don't really know that they're going to move much lower. They could just kind of stay sideways. They are much better suited for trading credit spreads than they are for trading debit spreads. And I just have one other example here. I have Williams %R. This is a similar type oscillator. It is not, or actually, this is a slightly different oscillator because this actually gives you buy and sell signals as opposed to necessarily giving you overbought, oversold, even though they do tell you overbought, oversold. You know, signals like Williams %R, as you can see here, when it crosses that zero line or that -50 line on Williams %R, these are buy signals. You can see the stock typically makes a quick move higher in one direction or another. When you get a sell signal, you get a quick move down. So this you can use with credit spreads or debit spreads. So when you have a clear signal, you get a clear move higher. This is kind of the exception of using an oscillator and using them with debit spreads as opposed to just credit spreads. And for those of you that have, you know, if you're not as familiar with trading debit versus credit spreads, we have a separate video specifically on this that I did a few weeks ago. I highly recommend you to watch that once you're done with this webinar. I'll send the link to that in the chat window once we're done here for those of you that are not as familiar with debit versus credit spreads, to look at the differences because they are very different in nature, and you should understand the differences before you start trading them in your account. So lastly, I just want to wrap this up before we start taking a look at some real examples here. Market analysis. This is something that's also very interesting, and it's another form of technical analysis, and there's lots of different ways to do this. There you can look at the relative strength of a stock compared to the overall market. That's what we look at with our technical score. I'll show you that in 1 second. You can look at the net 52-week highs of the overall market. You can look at intermarket analysis. There's all different ways to help you understand what the overall market is doing. It'll tell you kind of, you know, out of the S&P 500 stocks, how many of them are hitting 52-week highs versus 52-week lows. The more 52-week highs there are, the more bullish it is. The more 52-week lows there are, the more bearish it is. These types of analysis is really important to give you, and it's really important to understand that these are used for confirmation only, and that they should not be used as signals. So when you have, you know, lots of stocks hitting new 52-week highs, that's just used as a confirmation that if you're bullish on a stock, that might be a good market condition to enter a bullish trade on, and not a good market condition to enter a bearish trade on. But they're not a signal, meaning you shouldn't use them to simply enter a trade on that alone. You should have other forms of analysis, such as any of the examples that we gave you before, to create the actual signal, and you only want to use market analysis just to help confirm the overall direction that you're trading in. And this is typically used in what we call top-down approach. This is another thing that we cover in our directional webinars, which can all be found on our YouTube channel. This is where we look at the overall market first. Is the overall market bullish or bearish? If it's bullish, then we'll probably look for bullish sectors currently before we look at bullish stocks. Vice versa, if let's say we're looking at a bearish market, then we're looking at trying to find what sectors are bearish and then try to find individual stocks that are bearish. And by doing this type of top-down approach, we can really hone in on which stocks have the highest probability of moving higher versus which stocks have the highest probability of moving lower. So with that, let's just start taking a look at some real examples of some stocks. And I want to show you guys how we can use options play in conjunction with technical analysis to find you some trading strategies or some options trading strategies. So first off, I'm going to look at is just support and resistance, right? Because this is by far the most popular one. This is the easiest one to see. It's the one that we calculate already for you on your screen. So as you can see, XLF, you have a resistance level around 28.47, 28.5, and you have a support level at 26.47, so around 26.5. So you have this support level. So as the stock hits 26, it kind of bounces higher. As it hits 28.5, it bounces lower, and when it hits 26 again, it bounces higher. So it's based on this pattern, it's not crazy to think that this stock is, now that it hits 28, started to move a little lower, that it's going to continue back down to 26. And there's really two ways to trade this. You can either buy a debit spread that basically takes advantage of the stock going down to 26.50. So as you can see, that's what we have here on the right is a June 29th, 27 by 29 put vertical that takes advantage of the stock moving lower. And as if it does, you make 122% return. So it costs you $90 to place this bet. If you're right, you make $110 or 122% return. For those of you that are a bit more advanced at trading, you might want to even change your strikes. You might want to say, hey, I think it's going to go from 29.27 to 28.26. You can do that as well. And if you do that, it's only costing you $44 to place this bet, so half the price to place this bet. And if you're correct and the stock goes down to 26.50, you make $106 profit, which is a 240% return. So that's one way to play this using debit spreads. The other way to play this is using credit spreads. So you may not think that it's going to go all the way down to 26. Maybe you just think that it's not going to go above 28. So what you can do is you can click on modify for any of these strategies. And again, for those of you that are brand new to this platform, you can use our strategy constructor to construct a credit spread. So I can sell a credit spread here. So you can see I can collect $42 so that as the stock, if the stock stays exactly where it is, I still collect some money on this particular trade. You can change these strike prices if you want. There's not a lot of choices here because they're dollar strikes as opposed to 50-cent strikes. But as you can see here, as the stock, if it starts to move even modestly lower, like 27.5, let's say it goes back down to 27.60, which is where it was just a few days ago, you're going to make 100% profit. You're going to keep that $42 credit that you received by selling this credit spread. So those are two different ways that you can trade basically a stock trading near its support or resistance level. If you think the stock's going to go moving in one direction, you might want to trade the debit spread. If you simply think that it's kind of stopped and it won't go any higher or won't go any lower, you might want to sell a credit spread. Okay, let's take a look at a breakout trade. Here's Macy's. This is one of our trades from a couple of weeks ago. This is a trade that I believe we're going to try to close out today. This is a stock that jumped on earnings. It was actually an earnings play and ended up making that breakout that we're expecting. So maybe you think that this stock's going to continue moving higher. This is a classic breakout play. This is where you would expect that the stock's going to make a quick move higher. So this is typically where you'd want to buy a call option because it allows you to take advantage of the stock continually making a quick move in one direction. You can also take a look at the vertical. So it depends on kind of what your views are. So as you can see, this stock's just hit a new 52-week high. We don't really have a price target on this because it has never traded at these levels before. So maybe you think it'll go to 36, 37, 38. Who knows? No one really knows, right? So that's why, maybe trading a call or a call vertical sometimes makes sense because, as you can see, if I think the stock's going to move significantly higher, buying a call gives me a 96% return. Buying a vertical gives me 171% return. But that's assuming that I hold this all the way to expiration. But what if you think the stock's going to make a quick move higher to, let's say, $36 in just a couple of weeks? So today is the 17th. So what if you think on May 31st, 2 weeks later, that the stock's going to jump to $36? As you can see, the call gives you the higher return here. That's why when you get a gap and you think the stock's going to run away and keep going higher, buying that call is usually your better option compared to buying a debit spread because the debit spread takes advantage better if the stock moves slower, and that typically doesn't happen after a breakout. After breakouts, these things tend to move pretty fast. So keep that in mind. So that's an example of what you can do with a breakout. Now, the next example I'm going to give you is I'm going to use technical analysis to show you a trade, but I do want to illustrate something that just because we have good technical analysis doesn't always mean we can leverage an options trade out of that. So here is a trade. Now, this is, for those of you to the untrained eye, this just looks like a stock that's got a lot of volatility going up and down. But to the trained eye, what this really is a clear channel. As you can see, it's got a clear channel moving higher, higher lows and higher highs. And this is really kind of a channel. So every time it hits the bottom of the channel, it'll go to the top of the channel. And when it hits the top of the channel, it'll go back to the bottom of the channel. And it just continues to make higher highs, lower highs, higher highs, lower highs. And it's really not that crazy to think that this stock can easily move back up to this 38 resistance level. So there's different ways that you can play this. Now, because these tend to be relatively slower moving trades, you would typically use a debit spread, because not only do you have a specific entry price, you also have a fairly accurate target price. That's a great thing about these channels. So when I hit the top of this channel, I have a pretty good idea it's going to make a move down to roughly the bottom of that channel. Same thing here. When I hit that top of the channel, I knew it was going to likely make a move down to the bottom of the channel. Same thing again. When I move to the top of the channel, it's going to move down to the bottom of the channel. However, as you can see, even though I'm fairly confident that I think this stock's probably going to break higher above this resistance levels and go back up to that 38, maybe even go a little further above that 38 because we're expecting a new high. Look at this. On the other side, I'm not able to find a real strategy that makes sense. And this is common because you are going to find more trades on technical analysis than there will be option strategies available for you. So that's really why the options play tool is critical for your technical analysis, because if, let's say, you didn't have this panel here on the right and you were just looking at the chart and you say, great, I'm bullish on this chart, let me start trading, and you pulled up an option chain and you started scrolling through the different expirations and strike prices, a lot of times just looking at the option chain, you're not able to tell, is there a good option strategy for this? And that's really what options play here is designed to help you do. Not only are we here to help you find a good option strategy, more importantly, we want to prevent you from making bad ones. So buying this $35 call for $2.45 is actually really expensive, and that's why you get a really low options play score. So if you hit the trade button, as you can see, this option is trading at 155 by 245. That's a huge spread. And the options play score is very low, the liquidity is very bad. This is all pointing to, if you're bullish on the stock, you might be better off just buying the stock. Just because you're bullish on a stock doesn't always mean there's an option strategy to trade. And that's what I hope to illustrate here, is that you might come across a stock where you're very bullish on based on your technical analysis, but when you look at the options play score, if you look at, as you can see here, we can't even find an optimal vertical here. This is really telling you that if you're bullish on the stock, you're better off just buying the stock as opposed to trading the option. And that's really important because we don't want to force you to trade options because you want to trade options. You only want to trade options when it makes sense. And options play is here designed to help you illustrate that. So with that, let's just move on to the next example here. I only have a few minutes left here. Let's look at Apple. This is kind of a, what I think of this as kind of a continuation pattern. So depending on who you ask and how you look at this, you could say that this is a breakaway that's starting to kind of, really kind of took off on earnings and really started to move higher very quickly. And then it kind of slowed down and pulled back a little, back to this 185 support level, which was a major resistance level for quite some time. Kind of made that quick move higher, pulled back. This is usually the consolidation range that we typically see after a big move up, meaning the stocks don't really just continue moving higher. When they move higher, they got to consolidate for a while. They need to digest the move before they can continue going higher. So my expectation here for Apple is that it's going to digest a little bit. Whether that digestion takes 2 days or 2 weeks, I don't know for sure. but it's very likely that it's going to break above this 190, 191 level and really continue higher. So this is where you can use either buying a call or buying a call spread. Those are two different ways that allow you to take advantage of Apple moving significantly higher. So let's say you think the stock's going to move up to 200. Here, buying the call option that costs you $600 will return you 150% if it hits 200, which is only $10 higher, and that's not too crazy for Apple considering it's already moved easily double that amount in the last couple of weeks. So saying that it might move $10 in the next, or $15 in the next 45 days, I don't think is that crazy of an idea. And if you bought the call, you make 150% return. If you bought this call spread, you make 155% return. But if you expect a move to happen very quickly, so if you think the stock's going to move that, maybe in half that amount of time, as you can see, the call will give you 153% return versus the call spread will only give you 109% return. So this tool will also not only help you identify trades, but also compare different strategies so that you can say, should I buy that call? Should I buy that vertical? And definitively say exactly which one's suited for you. Now here, we don't really have a template for where Apple's going to go. I'm just going off of the fact that this stock made about a $15 move here. So I think it's not that crazy for it to make another $15 move higher, which is how I got to this $200 target. And that's really the benefit of technical analysis, because when I'm looking at fundamental analysis, I don't really get that target price per se, or those target prices are based on very, very loose valuations, and they could take months, if not years, to come through. Technical analysis allows me to quickly define a target price and even give me a relatively time frame as to when I can expect that move to happen. And that's really why I like to use options play. So with that, I'll leave you guys with one last example. Adobe Systems. This is an indicator. So as you can see here, it's the CCI indicator that generated this trade idea. This was one of our trade ideas for today. As you can see, this stock, every time it hit this overbought indicator, it kind of continued to move higher. When it hit overbought here, it continued to move higher. So we're kind of expecting the same thing. It kind of moved higher, pulled back, got to this oversold area, and we're basically expecting Adobe to continue moving higher. And this 230, 235 level is also a support level. So there's a double whammy here, if you will. We have both a support level to justify that we think it's not going to continue moving lower, and we have a buy signal on the CCI, which generally means that this stock might move a bit higher. So you can play this one of two ways. You can either buy a debit spread that really takes advantage of a move higher. How much higher? You can usually take the move here, so from about 220 to about 245, so about $15 higher. So you can say that I think the stock's going to move about $15 higher here. So it's at 235, so 250. It could be a target price. So you could say, I think the stock's going to move up to about 250, which is a 42% return on the call, a 71% return on the call spread. Or you can trade a credit spread by saying that I don't think the stock's going to go below 235. I don't necessarily know that it's going to go up to 250, but I certainly feel that fairly confident that it's not going to go below 235. So what you can do is you can sell a credit spread here. So a short put vertical. So you might want to sell some strikes that are slightly under the current price and collect some premium. So as long as the stock stays at the current price or higher, you're going to make that credit, that you're going to receive that credit for the trade. So that's the last example here that I have. I hope that, I know I went through a lot of these examples quickly, but I wanted to cover as many as possible for those of you, because I know technical analysis is a very diverse group of traders. So I wanted to cover a bit of, for as much as I possibly could for everyone. So with that, I hope you guys have found this webinar useful. Please, if you have any questions, please type into the chat window. I'll try to answer as many questions as I can. There's a question here saying, how do I get a copy of your slides? They will be sent to you with the recording once I'm done. So you'll be able to download the slides to follow along on the recording. Okay, so again, if you have any questions, please type into the chat window. Here's a question. How to use probability in your analysis using bull put credit spread? So probability is just telling you what what the probability of the stock being above or below your break-even price, but probability is only half the picture. Probability is weighted by the risk to reward. So as you can see, even though I have a high probability of 63% versus 36% on the debit spread, I'm risking 550 to only make 200. That's a pretty poor risk to reward ratio in my mind. Versus here, even though it's only 36%, but I'm risking $873 to make double that, $1,600. So the options play score tells you how well balanced the probability is weighted by the risk to reward. So as you can see, this debit spread gives me better risk to reward overall than trading that credit spread, because even though the credit spread gives me a higher probability, when I'm wrong, I'm actually risking a lot more than what I'm risking more than twice what I'm making on the credit. So that's really why we use the options play score and not probability in our analysis. Will you kindly provide the address of the debit spread video? Absolutely. So give me 1 second. I'm going to get that for you guys here while I get the other questions. 1 second here. So another question here. Does the chart set the levels automatically? I'm not sure which levels you're referring to, but for the most part, our charts do adjust fairly quickly or automatically on their own. So you should be able to do that. For those of you that are looking for our YouTube playlist, you can find all of those available there in that link. I just shared that to you in the chat window. You can find all of our videos on credit versus debit spreads and all the other ones, all the other terms that I might have spoken about here today. You can find them on our YouTube channel. Paul's saying, do you use ATR to help you set your stop loss? So ATR is a very popular way to set your stop losses. We personally don't, because we like to use support and resistance levels. ATRs are certainly one tool that in your toolbox that you could use, and I know it's very popular with a lot of traders. So yeah, you can certainly use them. Again, the thing about technical analysis is because there's literally infinite number of ways of using technical analysis. In order to gain any consistency, the key here is to use the same type of analysis day in and day out. If you use ATR today to set your stops and then use support and resistance tomorrow and then use moving averages the next day, you're going to get inconsistent results. If you're going to use ATR, stick to ATR. That's how you're going to be able to get consistency in your trading. Susan, great. Thank you very much. I'm glad that you guys have learned a lot. This is really what I'm here to do this is to try to show you as much as possible so that you guys can see how the different ways that you can utilize our platform for trading. Bruce is asking, are there other indicators such as CCI? Absolutely. Great question. Actually, I'm sorry that I didn't get to this earlier. So if you click on the expand button, so let me just show you guys this little expand button here on the upper right hand corner of your chart. You can put in any studies that you want. So you can put in an RSI, you can put in whatever studies that you like just by clicking on that expand button. You can see all the studies. We have about 80 different studies that you can add to your chart here. What do the red, pink, yellow squares indicate? Great question. So as you can see here on the upper right-hand corner of your screen, you have a 1 month and 6 month trend. That tells you the current 1 month and 6 month trend. However, what we do is we actually show you how that trend has changed over time. So as you can see, as you can see on Adobe, while this stock kind of pivoted and kind of consolidated and pulled back a little, the 6 month trend rate remained bullish this whole time. Only the 1 month trend turned neutral and slightly bearish here, and then eventually resumed its bullish trend. So these are when the trend resumes bullish, these are actually good signals to get in. When the 6 month trend stays solidly green and then you get a small pullback, once that 1 month trend resumes its bullish trend, that's usually an interesting time to consider getting in, or a signal to get into a trade. As you can see here on 5/1, it started resuming its bullish trend and moved significantly higher since then. So that's how you use these little 1 month and 6 month trend indicators. Any comments on Procter & Gamble going in the opposite direction? Great question. So this was a trade from a few days ago. If you followed this trade with us, you'll remember that I said 74 was a resistance level. As you can see, it's just trading right at that resistance level. So as of right now, this trade is still valid. The 6 month trend is still bearish, so I'm still expecting this stock to continue moving lower. The 1 month trend has turned neutral for a couple of days. That's not a problem either, because as you can see here, the stock as you can see, the 6-month trend remained bearish. And when the stock turned neutral, it actually continued to move lower afterwards. So I'm expecting similar things. However, if the stock does break above 74, then likely the 1-month trend will probably turn bullish and the 6-month trend will turn neutral. If that's the case and it breaks above 74, that's when I would consider our trade is wrong and we would get out of that trade. Great question. Where do I see live RSI and MACD? So I just showed you there right here. You click on the expand button, click on the studies button, and you can put in your MACD and RSI right here on your chart. Kyle's asking, what do you think of ADX as an indicator to define the trend? So all of these indicators tell you roughly the same thing. ADX is no different than any of the other ones. Again, I don't think that one indicator is ever better than the other. I think what's more important than which indicator you use is to use one indicator all the time. Meaning if you use ADX today and then use RSI tomorrow and MACD the day after, you're going to get inconsistent results. If you like ADX, stick with ADX. They're all doing the same thing. They just have different calculations and different methodologies to try to achieve the same thing. I'm sure each inventor will say that theirs is better than the other, but at the end of the day, they're all trying to just define when a stock is overbought and when it's oversold. And it's important to understand that when you're looking at overbought and oversold, that it's best to use credit spreads in that particular case. So it doesn't matter whether you use RSI, MACD, ADX, or any of that. The important thing is that they all tell you overbought, oversold, and it's just important that when you find that it's overbought, sell a call credit spread. When it's oversold, sell a put credit spread. That's how you can utilize options with your technical analysis. What does technical score of 9 mean? Great question. So technical score, I don't remember if it was that was Adobe that said that. Yeah. So technical score just means that this was the market analysis that I was talking about, right? So these are not buy or sell signals. These are simply confirmations. So a technical score of 9 tells me this is a very strong stock. It's outperforming the overall market. I use this as a confirmation because if I'm bullish on a stock, I usually want to buy a stock that's outperforming the market. If I'm bearish a stock, I want to short a stock that's underperforming the market. And that's what this market analysis tells me, is that it's not a signal to buy or sell. It's just a confirmation for my buy or sell signal that I got from other methods. So great question on the technical score. David's asking, how many trading days would you give Procter & Gamble before you bail? So usually I like to give it at least 2 trading days above a resistance level that I was expecting to hold. Because as you can see here, it went above that resistance level for 1 day and came right back down, right? Same thing here. Went above that resistance level for a couple of days and came back down. So I usually like to give at least 2 days. The other rule of thumb is that, if the spread that we bought has lost more than 50%, then I would also get out. That's just more of a risk management, money management rule that I have. So the support and resistance and text and lines across are created by the platform. Correct. These are created by our platform. It's proprietary to us. I was one of the people who created the algorithm to calculate that. I'm actually very proud of them. It's something that you don't get on Thinkorswim or any other platform, and it's something that we use. That I've learned from my years of trading and using technical analysis to create them, and they're automatically created for you and drawn for you on your chart, so that you can see kind of where they are. And we also tell you how far the stock needs to move to hit that next resistance or next support level. Is there a way I can check the effect of a trade on margin? So that's a slightly different question. I'm happy to answer that. If you just shoot me an email afterwards to info@optionsplay.com, I'm happy to answer that question. I just want to keep the questions to technical analysis and options trading for right now. Any other questions? Looks like I'm at the end here. One question just quickly about watch list. So the watch list is you can see it's created for you. We have a ton of pre-built watch lists for you. I highly recommend you to look at the spiders, which is the default watch list. This gives you an idea as far as when you sort it by score, which is this technical score that I was referring to. It allows you to quickly see which sectors are strong, which sectors are weak. So energy is a very strong sector. Consumer staples is a very weak sector. So when you're looking at individual stocks, you should keep this in mind. If you're trading a consumer staple stock, you're more likely going to look for some bearish opportunities. If you're looking at energy stocks, you're more likely looking at bullish opportunities. This helps frame your mind. This is market analysis that helps provide confirmation. They're not signals themselves, but if you're looking at a particular stock and you're seeing that, hey, I'm looking at a bearish stock and it happens to be in the utility sector and it's a weak sector, great. That's just confirmation for my trade. Or if I'm looking at Macy's and it's in consumer discretionary, it's a very strong sector, great. That confirms my bullish views on Macy's. So again, these are all things that you can use as part of your technical analysis. The one thing that I have to stress is, regardless of which one of these methods you choose or which one of these methods that resonates with you, just try to stick to one or two and stick to them, as opposed to constantly switching from one to the other, because that's when you get inconsistent results. And the second part is really just making sure that you apply the right option strategies to the type of trading that you're doing. So if you're doing breakouts and breakdowns, use calls and puts. If you're using oscillators, use credit spreads. So make sure you use the appropriate strategy for the analysis that you're doing. What do the two red resistance figures at the bottom represent? That just tells you the next resistance level. So as you can see, it highlights those on the screen for me, it tells me where that next support or resistance level is, and tells you how far the stock needs to move to hit that next resistance or next support level. So, I'm coming up on an hour here, so I'm going to have to wrap this up. I really want to thank all of you for taking the time out this afternoon and sitting here through this full hour. I really hope that you guys found this useful. This webinar is recorded, so I'll be sending you this recording in about 30 minutes or so with the slides. Please, if you have any questions, please send them to info@optionsplay.com. And again, for those of you that want to view our other playlists, so if you want to know about credit spreads, go to our YouTube channel, which I just created a link for you guys in the chat window. Go to that YouTube channel. We have all of our webinars there. Take a look, and please send us your questions, and I'll be back. I won't be here next week, but I will be back here in 2 weeks to do another webinar for you guys. So thank you very much for taking the time out this afternoon, and I hope you guys have a great day.